Stellar's economic and market update for the second quarter of 2022. I'm Chris Hostetler here today with David Wise. And Dave, I am glad you're here because I make it a rule to surround myself with people who are smarter and better looking than I am.
You sell yourselves too short.
I appreciate that. Look, it was almost difficult for us to figure out where we should take this call today because there's so much going on in the world right now. And this is where it helps to have a process. So Dave, I guess we should start as we always do with a recap of the latest quarter and ongoing trends. So why don't you get us started?
Absolutely. I think, heading into this year, it's been pretty amazing run coming out of the pandemic, and obviously still in a pandemic, but just the economy opening. So it's been a bumpier ride out of a stellar 2021. Stocks and bonds both saw a correction down over 10% at various times. And the stock market tends to see those corrections at least every 12 months or so, but this is pretty unusual for bonds to be down as much as they are. This is mainly coming from a shift in Fed policy on both ends, and we've seen both indices bounce back this week. But most of the volatility year to date has come at the hands of higher inflation, changing interest rate expectations, and Russia's war on Ukraine.
Yeah, and probably the biggest economic story of this year is central bank policy. So for us in the U.S., it's the Federal Reserve or the Fed, and around 20 of the world's central banks have recently begun monetary tightening, which is largely accomplished by raising interest rates, also by reducing the holdings of bonds and other income investments on central bank balance sheets. On May 4th, the US Federal Reserve or the Fed raised the target rate by 0.5%. This was the first time in more than 20 years that they've raised by more than a quarter point. So this signals just how aggressively they're approaching this inflation issue. The outlook for the US rate is for the federal funds target rate to be around 2.25% or 2.5% by the end of this year, most likely. This has a number of impacts. There are some negative impacts, of course. We're seeing this play out in mortgage rates, for example. 6 months ago, Dave, you could get a 30-year mortgage for 3%. Now it's over 5%.
Not so much.
Yeah, we will also see rising rates for auto loans, for credit cards, and also on the institutional side, business loans and the rates of borrowing between financial institutions are likely to increase. All of this has the impact of slowing down the flow of money. And as the Fed hopes, taking the foot off the gas pedal of inflation. Rising rates can also lead to volatility in the markets as the supply of cash is reduced. It's not all bad, though. There are some positive impacts of rising rates. Higher interest rates can incentivize saving, which brings long-term personal finance benefits. They can also provide higher income for bond investments, which particularly helps the more income-focused investments of older savers. And higher rates can also give the Federal Reserve more capacity to reduce rates during a future economic downturn to provide further support when the economy needs it. There has not been that capacity with rates being as low as they have been. With inflation, we don't believe it's going away anytime soon. So this is likely to be impacting prices now and through the remainder of this year, probably into 2023. So we're probably looking at not just this interest rate increase, but a campaign of rate increases from the Fed. We're also seeing a very tight labor market right now. There are more jobs available than there are people looking for jobs, and that gives the Fed further room to continue raising rates. There's a bit of really good news buried in there, which is that unemployment numbers are low. They're back to the historically low levels that we saw pre-COVID, which is pretty amazing, frankly. So there has been some negative news this year, but also some very positive news.
Yeah, along those lines, COVID typically has been the big story. Every quarter we come up and it's just COVID. But at this point in time, with over 90% of the population having some form of immunity, whether they've been vaccinated or they've contracted the disease or a combination of both, it seems that we're finally getting closer to putting COVID into the same box as the flu. And I think that's our hope. They've even discussed whether we're entering an endemic phase where it's kind of just a regular disease that we have to deal with. I think that's the hope, of course. With that, we're seeing a different response in China. U.S. and some other places around the world have fully opened their economy. China has a zero tolerance policy with COVID, so they've shut things down, and that could weigh on the economy, the larger economy, and hurt supply chains, which could exacerbate inflation to a certain extent. So we're watching that as well. One other thing to note: first quarter GDP came in negative, and that seems alarming at first, but it's a little misleading unless you break down the results of the calculations. We kind of knew coming in this year GDP growth was going to moderate towards 2% long-term trends. Most of the weakness, though, this first quarter came from a normalization in inventories and a significant trade imbalance. And on the surface, as I mentioned, that might be worrisome, but in the fourth quarter, we saw companies really stock up on their inventories, which helped out that GDP number. And then for the latter, the strong consumer demand has actually led to the widening trade imbalance, which actually points to the strength of the consumer, which is the engine of our economy. So, Chris, as we think about our outlook moving forward, what are we telling clients? How are those discussions going?
Yeah, the one thing that we can count on is more volatility. Wish we could say otherwise, but we are pretty certain that prices are going to be choppy. With that being said, the U.S. equity outlook still has a lot of positives. We see, strong fundamentals for corporate balance sheets. We see corporate profitability. The consumers are strong, as you mentioned, and we're still seeing spending at pretty high levels and possibly continuing to increase, with the caveat there that rising interest rates could slow spending down by design, actually. We do expect U.S. economic growth to slow. You just talked about Q1 growth being negative. We do expect a rebound this quarter and likely for the rest of the year as the economy continues to come out of the COVID environment. Now, a recession would be defined as 2 consecutive quarters of negative growth. So by definition, we're already halfway there, but as of right now, we do not expect negative growth this quarter, and we do not expect to see a recession this year. Possibly next year, though. So, and possibly this year, I should say, but that's just where we think the probabilities are right now.
Yeah, there's always a chance, right? Yeah, there's always a chance of a recession every year, but at this point in time, all eyes are on the Fed and inflation and what happens with consumer spending in the face of higher inflation, as you mentioned. If inflation stays too high for too long, there could be a tipping point where we see consumers that stifle the spending that we have seen in the past. And the Fed is in a tough spot, right? They have to raise rates just enough to combat inflation, but not too much in order to stall the economy. So they're looking for that soft landing that they speak about in the news. And it's going to be a tough one, but we're hopeful that they can make that happen. Valuations, thinking about the pullback that we've experienced, and potential opportunities, and something we're always keeping in mind. And on the international side, those stocks are much more attractive than U.S. stocks, but we also understand the near-term difficulty with Ukraine and Russia and that conflict that's weighing on the European countries that lean more heavily on Russia for some energy imports on energy. And then when we look at just market pullbacks in general and stocks being cheaper, since we are long-term investors, these pullbacks typically present other opportunities. So we're constantly looking for ways that we can rebalance and buy into the market at cheaper prices. Some of the other risks that are on our mind is the new variant, the AB2 that's out there. As I mentioned, it's not as big of a deal here in the U.S., but in China, how that plays out. And I think it's really important to note that the economy just doesn't turn on a dime. It's like a cruise ship in the ocean. It takes a good amount of time to flip it 180 degrees. But would you mention anything else on our outlook, Chris?
Yeah, you touched very briefly on Ukraine. You touched on the impact of virus variants in China, and those point to a trend that may or may not be occurring right now, which is the potential for deglobalization. Obviously, with the horrific humanity story that we're seeing in Ukraine, there are tremendously devastating impacts to the economy there and in surrounding areas. And there's the possibility that that could kind of amplify the trend that we may have been seeing politically over the last few years,
Hmm.
where supply chains are impacted to the point that companies or sorry, countries continue to perform more economic activities, more diverse economic
Hmm.
activities at home, like in their own country,
Hmm.
and we see lessening global trade. There's a
Yeah.
lot of talk of that going on right now, but it very well could be political rhetoric. We've
Yeah.
seen some analysts say that there's probably just too much momentum for the economy to be substantially regionalized or
Hmm.
deglobalized, however you want to say it,
Yeah.
that we're probably still going to see a highly global and increasingly global economy.
That's a good point. That's a good point. So how are we managing the market environment? What decisions have we been making more recently?
Yeah, we always need to lead with the somewhat boring, because we say it every time, recommendation that you need to maintain a diversified portfolio. We also want to look for rebalancing opportunities. When the markets are choppy, and especially when parts of the market are heading in different directions, that gives us the opportunity to rebalance from one allocation to another. Um, Further, we at Hilltop are taking this opportunity in the markets to do some tax loss harvesting, where we sell
Hmm.
investments at a loss in our non-retirement accounts in order to save some money on capital gains.
Hmm.
Um, and of course, rebalancing into similar investments so that we stay invested and we stay in the markets, don't give up the opportunity that has been created by lower prices. On the equity side, we are maintaining our allocation to international stocks, where valuations continue to look cheaper than they do in domestic US based
Hmm.
stocks.
Yeah, yeah, and just to add on to that, thinking about the bond side of the equation, in our last quarter we shortened duration, so the term to maturity for our bonds. We want shorter term bonds so that we can take that money and reinvest at better interest rates, better bonds as interest rates move forward and upward. And so we're continuing to actually reposition into more shorter term bonds to reduce that duration or that term to maturity on the average on that side. And we think that's going to help allow us to be a little more nimble, but also maybe combat some of that headwind with rising rates. On the stock side, we added real estate, and we still have a pretty strong conviction there. Real estate does well during higher inflationary time periods, and we've seen that so far year to date. And they're just in a post-COVID world. It seems like there's more opportunities within real estate. So cell towers, as we mentioned before, data storage facilities, and then distribution warehouses. We got clients all over the world, but one client of mine that comes to mind is just in Mebane, and there's just distribution warehouses going everywhere. Mebane, North Carolina, for those folks living outside of NC. And it's just interesting to see those pop up because we've seen this huge change in consumer preferences and consumer behaviors shifting towards online, the digital economy. So
Yeah,
we're always looking for new opportunities, but those are the ones that we've put our money into and shifted our focus on.
yeah. Great summary. That's probably a good place for us to close. We could go on for days. We have gone on for days internally, but we
Yeah.
won't drag you through all of that. We thank you for watching, and we hope you've enjoyed this and learned something. And if you're not already working with Hilltop, know that we are always happy to talk with you. So feel free to reach out. To learn more, you can check out our website and look at the Hilltop Views blog to see our thought process. Thank you.
We'll see you next time.